Now just 3 years ago I started investing with just £330. Today that portfolio is worth over £70,000. Along the way I've tried different strategies, different platforms, different stocks and ETFs, and over the past year I've settled into what I believe is the best long-term approach. One that's giving me both stability but also consistent growth. This month I'm going to make some changes, and being completely transparent on this channel, I'm going to guide you through these changes and why I'm making them. Right now I have 3 different investment portfolios, so before we get into these changes, let's have a quick background on what these are. First up is my largest and oldest portfolio, and this is on the Vanguard platform. Within this portfolio there's a variety of different ETFs, and it currently totals just over £46,000. This portfolio was my main focus for the first couple of years, but I haven't touched it since last March, and it's still been compounding quietly in the background. My second portfolio is currently my most used. This is over on Invest Engine, and this currently has around £18,000 invested. For me, this replaced my main priority from Vanguard. This is where I built my DIY globally diversified portfolio. I took everything I'd learned over the past few years and built this portfolio with lower fees in mind, broader diversification and a slightly higher dividend. And finally there's my Trading 212 portfolio. Now this makes up around 10% of my overall investments, and it's where I like to keep my more riskier investments. It gives me freedom to try out any high risk ideas or stocks, but given that it's only 10% of my portfolio, I can afford to have these more riskier investments. If you're interested in seeing every single stock and ETF within these portfolios, then I recently did a portfolio update. I'll leave the link to this at the end of the video if you want to check that out. With the stage laid out, let's get into that first change I'm making. Okay, so one of the first changes I'm making is selling a couple of my individual stocks. So this is my stocks ISA on the Trading 212 platform, where I trade the individual stocks. Now, we'll kind of ignore the fact that we're very much in the red at the moment. The stock market, especially in the tech and AI sector, is having a bit of a terrible time at the moment, but that's really not what this change is about. You can see my individual holdings here, where we've suffered some bad losses, but the key ones I want you to look at here at the bottom is Google or Alphabet and also Shopify. Now, we're down at the moment. As soon as these go back into the green, I'm going to sell these individual stocks. Now, the reason for this is that the bulk of my investments are held within ETFs on Vanguard and Invest Engine. And obviously a large portion of that is held within the top companies within the US. Google in particular is obviously one of them. And I worked out between those, I've already got around £1,500 invested within Google. So to then have it again on Trading 212 seems a bit like too much overlap and a little bit unnecessary. I already have a relatively large holding in that company. I think at the time I started reading a lot around Google and I thought, yep, let's dip my toe into this stock, but in hindsight, probably a mistake. So the view going forward is to keep Trading 212 with sort of more small to mid cap stocks, which I have a good feeling about, or stocks that I've researched heavily and think there could be really good growth, or this could grow into a, quite a large company in the future. I almost want to avoid the large cap stocks because, like I say, they're already covered within my ETF. So, yep, that's going to be the first change. The second some of these are back into green, I'll be selling them. And with that leftover money, I'll be putting them basically back into some of these smaller companies where I'm predicting better future growth. Okay, so change number 2 is also on my Trading 212 platform. You can see that I'm going to be changing quite a lot here. And you can see here, so if we look at this top holding here, 100 shares of SoFi, just over £1,400 worth in that stock. Now, for me, that's great. That's a fairly decent holding. And the top ones there, Grab, AMD, even Rolls-Royce and Take-Two, they're of a decent size of investment. And when we come towards the bottom, Palantir, Marks and Spencer's, Applied Digital, Google and Shopify, especially Shopify there at the bottom, buying one share, that was my way of thinking, okay, well, I'll start building on this stock, but ultimately, I'm in a position now with my portfolio whereby I'm looking for sort of larger returns. Now, take Shopify, for example, there. If that goes up 10%, great, 10% gains, fantastic, but it'll only make me around £8 on that particular stock. Whereas we go to the top end of my portfolio, we can see here SoFi, for example, if that goes up 10%, we're looking at £140 worth of gains. So I think instead of diversifying myself and spreading the money that thinly, I'm going to, get rid of sort of the bottom stocks. Or the second part of this is, instead of adding any more stocks, I'm going to build on the ones I've already got and try and get them all to a minimum of sort of £1,000 investment. That way, when they do grow, that growth is a sizable amount. And all I'm really doing by adding loads of stocks which have quite low exposure or low weightings is I'm diversifying. And that's not really what this portfolio is about. This is my sort of risk-taking portfolio. My ETFs on Invest Engine and Vanguard is really where that diversification will come from, so I don't really need to do that here. So yeah, we'll basically be shedding weight off the bottom half to then top up the top half and have a decent weighting within a lesser amount of stocks. Okay, so change number 3 comes in the form of adding commodities to my portfolio. As it stands, all of my investments are within equities or stocks. The 3 commodities I'm thinking of adding is gold, silver and copper, and by adding these into my portfolio, especially on Invest Engine or even Vanguard, I'm diversifying even further, which is what those portfolios are all about. Now, starting with copper. Copper is essential for things such as electric cars, data centres and renewable energy, all areas in which high demand is likely to continue. At the same time, new copper mines take years and years to build, so supply isn't catching up to demand yet. That combination makes copper a long-term attractive proposition. Now, when it comes to gold, it's always been seen as a bit of a store of value and a safe haven during uncertain times. Central banks and investors use it to hedge against inflation, currency weakness and market volatility. It doesn't rely on company profits, which means it acts different to stocks. This can play a key role when looking to add more diversification. Now, when it comes to silver, this is an interesting one, because it's both a precious metal and an industrial one. It's used heavily in solar panels, electronics and electric vehicles, but it's also seen as a safe haven similar to gold. So my current plan is to add these 3 in some form within the Invest Engine platform that I have. I'm going to reduce the weightings within the current ETFs by between 5 and 7.5%. This will free me room to add these commodities within this portfolio, and my plan is to do this in the form of ETFs. I'll make sure to share the exact ETFs I'm going to pursue for this. I'm still in the research phase, but once I've decided, I'll make a full video going into detail on this. Okay, so my 4th change is quite a small one, but equally, it's probably more personal, and it's just something I am going to change, so I want to be fully transparent. So you can see at the moment, this is my Invest Engine platform, just over £18,000 in there, and I only started investing in this one since April of last year, so we've added quite a lot here, and the gains have been really good. But you can see here that my savings plan is £1,000 a month. So this is how much I debit into this account and invest, whether the market's high or low. Essentially dollar cost averaging or pound cost averaging if you're here in the UK. Now what that has meant is that over the year I'll invest £12,000, but really I want to maximise that £20,000 ISA allowance, which has kind of meant I've had this £8,000 shortfall, which coming to the back end of the year, I'm now having to frantically try and top this up, and £8,000 is a lot of money. I think I could be a bit more organised with this. So the plan is to basically upgrade this from £1,000 a month to £1,250. And what that'll give me is, over the full term of the year, that will have invested £15,000, throughout the months. And it only then leaves me with £5,000 to try and find to top that up, to make the most of the full ISA allowance. So really small change, but it'll hold me more accountable, and it also means more money will be invested earlier, which is better for long-term gains. Okay, so for my 5th change, this is on the Vanguard platform itself, but really I'd like your input on this. So you can see at the moment we've got just over £46,000 in this account, and I've basically left this untouched since I was using this portfolio, and it has been growing steadily in the background. But this was an account that I was playing around with different strategies, playing around with different ETFs, and ultimately, you can see we've got a bit of overlap. We've got emerging markets here, the FTSE 100, developed Europe excluding the UK, so none of these so far overlap. We've then got the S&P 500, but this is where there is overlap. I've then also got an all-world fund in there, and now looking back, it seems really pointless to have an all-world and then have all these different ETFs also trying to replicate in, you know, a diversified all-world piece as well. So yeah, my current thought is, do I sell all of these ETFs and then put all of that money, including this Japan one, and put all of them into VWRL, which is that FTSE all-world fund. Just for kind of, I don't know whether it's a case of me just trying to tidy up the portfolio or whether the returns would necessarily be any better, but yeah, I don't know if I'm changing it for the sake of changing it, but be interesting to hear your thoughts on whether you tidy this up a little bit and put everything just within an all-world fund and then kind of set and forget it. So yeah, keen to hear your thoughts. So those are the changes I'm making for 2026. And yes, some of them might seem minor, but they're all about being more efficient and creating a more diversified and higher quality portfolio. Aside from the changes I've mentioned, the key is generally to just keep dollar cost averaging and head towards that £100,000 portfolio mark. If you've spotted anything within my portfolios that you'd maybe do differently, or any changes that you'd implement, then please do let me know down in the comments section. If you've enjoyed this video, then don't forget to like and subscribe because it really helps the channel. Thanks for watching, and I'll see you in the next one.